Ta-da! The doors are open. We'll let everybody get in and get settled. And I need to turn all my little notifications off so we can stay focused. We got lots of questions, which is good. We got celebrity underwriters. So celebrity underwriters. So that's good.
I guess that's it.
That's awesome. So we're closing in on 11:59. Everybody's anxiously awaiting the Fed announcement today.
Yep.
So yeah, so funny. I was in a networking event this morning with about 80 different people. And if anybody was remotely tied to the real estate world or financial, they all talked about the Fed announcement in their 15-second intro. I'm like, really? So anyway, I thought it was kind of interesting, whether they were a financial planner, a real estate agent, and there was only two mortgage guys in the room. So there was one great mortgage guy and then some other guy. So some other guy. I'm only teasing. Actually, he's a friend of mine, so it's all good. At this point, everybody, whoever's left in the mortgage business, are all friends of mine. So yeah, we talk about that as we're letting everybody in the door. Mortgage loan officers and our realtor partners probably know this. Mortgage loan officers as an industry are down about 40% from where they were in 2023. So a lot of people got out. So all right, so Tony's getting through some of the basics in our chat, which has to deal with the Jimmy John's orders. You guys we didn't get a sponsor this time. I think we were just busy. So ultimately, any of the sandwiches that are delivered out there are courtesy of moi. So we do appreciate you guys jumping in. I love this session because we get to answer a lot of things, and I'm sure I'm going to learn some things too along the way, which is good. I didn't pre-read the underwriting questions. I've been so busy, so I'm gonna actually be reading them live. What? It's gonna be fun. All right, so we're gonna get in some basic introductions. I'm gonna start with myself in the mortgage business for over 30 years. And with CrossCountry, it'll be 13 years this January. CrossCountry, for those of you who don't know it, is the #1 retail lender in the United States. Retail meaning direct to the public, which means we do work with our realtor partners and our customers. Super, super exciting. Speaking of people that have been around for a minute, as far as with the company, we have Kim Martin with us, and Kim's been with the company for 6 years, and also in the mortgage underwriting field, correct me if I'm wrong, for 28.
Yep.
Got in when she was 2. Awesome. And she was the 63rd underwriter we have here, and we now have over 400 underwriters. So we're doing a lot of business here, and our underwriting is one of this company's strengths. So I'm very, very honored to have Kim. Jolene is newer with us, and Jolene has been in the underwriting position since 2014. And prior to that was a loan processor. That tends to be the natural progression. You process and then you go, I think I could do that other job. So there you go. So Jolene's been with us now for 2.5 years, and we have remote underwriters. Everybody always asks, is the underwriters in your office? No, we have so many underwriters. They're all over the country. Jolene, what state are you in?
I'm in Nashville, Tennessee.
Nashville, Tennessee. Oh,
Yeah.
Nashville's state. I like it. Kim, what state are you in?
I'm in Colorado.
There you go. There you go. All right. All right, guys. So Frank says he can't hear anything. So Tony's doing a little sound check. I need to check the messages. And Frank said he checked his computer. People say logged in, getting a little feedback that it's good. Guys, give me a little feedback in the chat if you can hear us to make sure that our sound is good. So I know Denise said is good. So that's awesome. Ladina's back. She was at our wine event yesterday. We had a wonderful time out there. I did not leave till late, so which is good. All right, Kim Wick says the sound is good. All right, so we got a thumbs up from Patrick Freefa. Okay, all right, guys, we're gonna jump in it. I love this session, so please keep in mind when we go forward with this, these are our underwriters that handle conventional loans, FHA loans, and VA loans. We did have a session before about the weird loans. We call them our signature loans. We won't probably not be able to answer too many questions on that because these guys don't underwrite that. So with that, we're going to get started. Oh, wait, ladies, do you have anything else you want to say before I jump in with questions? Okay, are you ready? By the way, you guys who are here can also jump into the chat and ask questions. So, Amico Pope says, "Oh, how can I best prepare my clients to successfully make it through underwriting?" Ooh, that's a fun question. How does a realtor successfully? By the way, I think that's my job, but I'll let you guys answer.
I do love that question because it just shows that that realtors and the agents are so involved with the relationship building, right? And it is a tough thing, especially I have a lot of friends here in Colorado that are realtors, and they use and abuse me all the time to ask me, "Is this normal? How do I do this? What's going on?" And it is kind of like the Oz, right? We're behind the curtain. Not a lot of people understand underwriting. A lot of people don't know what it entails. And truthfully, with making your bar, and Rich, jump in anytime, but I would say as a realtor, as an agent, I would tell my borrowers or my buyers, you're going to be asked a lot of questions about stuff that you don't even think is pertinent to the loan, and just be open to it because you know we want to do it as quick as possible. We want to one and done, get the loan approved, get everything all set so we meet all contingency dates. And so in order to do that, we ask a lot of questions, and Rich's team is great about it. I'm going to pass it over to you, whatever else you
Sure.
want to add to that.
No, it's good. I mean, from an agent standpoint, I think the biggest thing they can do is let's three things we'll call it. Number one, make sure you tell your clients that when your lender asks for something, they need it when they ask for it. The
Mhm.
biggest delay we ever have with regards to closing on time is the client themselves and them we've asking them for the same thing every other day. And hey, I know everybody's busy and everybody's got life going on, but if you want to advise your client, the best way to help themselves is when the lender asks for something, imagine it was due yesterday. So that's really one of the key things that you can do. And then, of course, let them know, hey, hang on to your paperwork. Your lender is going to need a couple months' bank statements, current paycheck stubs, things of that nature. The most important thing, and it kind of leads into what Amico's next question is, the most important thing, though, is if you're going to change your job from the time you get pre-approved to the time you close, you need to let us know. We can't find out in underwriting. By the way, we are required, not just because we're being mean, we are required to verify employment within 24 hours of closing. Otherwise, I can't sell that loan. So you have job changes. That's one of the things comes up. So Amico asked, what are the common hiccups that you encounter? So we'll put that back on you ladies. Like, what's the most common? Hey, you're underwriting a loan, and oops, you just see something in there that's a little that creates some chaos. Let's say.
Uh, well, when we're initially underwriting a file, I would tell you that the biggest hiccup that we find is that there's income discrepancies where a borrower thinks that they are making and or working 40 hours a week, right? People who work 40 hours a week or close to 40 hours a week assume that they're salaried. That's changed since COVID, right? Because a lot of companies have cut back on their hours, but the employees don't feel that. They feel like they're still working the same amount.
Mhm.
So they're like, I made $150,000 a year. But yet when you get the pay stubs, they're actually not working those 40 hours. They're working 38, they're working 35, they're working whatever.
Okay.
And we have to calculate that out. So when it comes in, we think that the borrower is going to qualify for more when they qualify for just a little bit less because their income has changed a little bit. That's the initial thing that I see.
Mhm.
Jolene, what hiccups do you think that we've seen?
I agree. The variable income portion is a big deal. Also, I think like as far as the assets, like moving around your money and getting new credit, things like that. I think if they're prepared up front, like, hey, if you're looking for a house, be sure you're not going out and getting new things before, you meet with your lender. Because those are sometimes that $5 or $10 payment can make or break it. And so it's just very tough to know until we get it in front of us and we can be like, okay, you're good to go. These are, your easy conditions, and let's keep rolling. So I just think
Yeah.
it's important to prepare them up front
Yeah.
for the little things that we might ask for. And there's always a reason for it. Because of course, as underwriters, we want to just look at it as quickly as possible, get you the cleanest approval, and get your docs out like as soon as possible. So
Yeah,
we don't want to hold it up for you.
No.
for sure. No, that's good stuff. All right. Lisa asks, so, not sure how this question comes in, but financing. So I think I don't know that this is an underwriting question, but we'll put it out there because I know where she's going with the question. So she's talking about getting a mortgage where we've got credits for the buyer from the seller. Oh, okay. You're getting a mortgage with credits for the buyer's agent's compensation, and now the appraisal goes low. So, the question I think becomes, it's really not an underwriting issue per se. Now you've got a situation, does your seller want to provide you the same credits and still honor that lower appraisal price? That's really between the seller. The underwriters don't really get involved in that. We either have the credits or we don't have the credits. One of the things that's really clear is all of the agencies have said, look, if the seller is going to assist in paying the buyer's agent's compensation, that has no impact on their maximum credits that are available. So that's out there. I don't know that, I don't know any other way to address that question. And certainly, Lisa, if you're on, please throw or elaborate in the chat. And let me know, because I don't want to not answer your question, but I don't know that I quite understood the whole thing. All right, let's see here. We've got, all right. So Anissa asks, can you explain the key factors you consider when evaluating a loan application and how they might impact your decision? I think maybe we sum that up, ladies, as the 3 C's. We talk about the 3 C's. Okay,
Yeah.
I'll let you guys go.
The 3 C's, the 5 C's, there's a lot of C's, right? The first one is collateral, of course. You have to look at the property. You have to look at title to make sure that we have a clear title so that our lien is not encumbered, that there's nothing that is impacting what the seller can do to sell it to our borrowers. And then that includes value, right? The type of collateral that we have. Is it a dome home where it's attached to a side of a mountain? Or is this a regular stick-built home, manufactured? All of those things that we have to go into when looking at that, and value. Supporting the value off of the appraisals, which I know probably gives all of you heartburn because we don't know what the appraiser is going to come up with.
So the first C is collateral. The next
collateral.
C.
Yep, yeah. Collateral. Credit is the next one, right? Credit is the main thing is the past credit history. So if a borrower has had a foreclosure within a seasoning time frame, then we can't do the loan unless there's some extenuating circumstances that cause that. So credit is a big thing. Credit history is a big thing. Of course, credit scores are the main thing that we start with, and then we start looking at credit history. That also goes with mortgage payments, and sometimes if we manually underwrite a file, you need rents as well. So that includes that. The next C is cash. I don't know that that's what everybody uses, but that's what I say. Because that's your
cash
assets.
Is king.
Yeah, cash is king. That's your assets. Down payment, if there's gift funds coming in, what their assets look like. Do they have reserves if they need reserves to close this type of loan, and all of that. My next C is capacity. That goes with your debt to income ratios, right? Because it has to be below a specific debt to income ratio based off of whatever program. And that usually averages for a conventional loan 45% and averages for an FHA loan 53%, 55%. And then, of course, if you're using the bond loans, which we all love, to be honest with you, I know that it's a little heartburn again for everybody, but near and dear to my heart, I think it's a great affordable lending drive, but making sure that they have the ability to make that payment. And in our little world, we call that ATR, which is ability to repay.
Got it. That's good. Yeah, that's cool. So those C's, those kind of cover, as far as the key factors. So that was a great question, Anissa, and a great answer for you guys as well. And yes, when in Illinois, it's IDA for Illinois Housing Development Authority. All right, Vernita asks, and I do like this question too. When representing a buyer client on a condominium, what steps should the realtor take to ensure that the condo building is in good standing for approval? And then she followed this up. The reason she's asking the question is she had a client lose money on an inspection and an appraisal, which, you add those things up, could be close to $1,000. It's a big deal. And again, no fault to their own, but the property wasn't eligible for financing. Now, we're talking about two different types of financing. I don't know if you guys want to maybe cover conventional, one of you, and maybe FHA another, because there are different guidelines per. One thing to keep in mind, especially for any new agents, and I know I've done some new agent training in the last couple of weeks, condos are definitely different. The condo itself also needs to be approved in addition to the client. With that, I'm going to segue to our underwriters.
I'll start with Govies. Is that okay, Jolene? And then you can
FHA, VA. Perfect. Yeah.
So just so that you know how it works at CrossCountry, because we are the best, I will say, I love this company so much, but we have our own specific condo department that does take that on, and they take a look at the condo questionnaires that Rich and his team orders. Then they determine if it meets the guidelines. Now, taking a step back away from CrossCountry as just agency guidelines, VA and FHA have their own approval system. So you can definitely go to HUD.gov for FHA loans, and you can look up the condo name, subdivision, and state and city, and it will tell you if it's approved or if it's not approved. So that's the number one stop, right? Like, just stop and then check that out if you're doing an FHA loan, or if you think that it's going to be. Like, if it's definitely approved with FHA, then you're on a good path. VA, gosh, I used to say that this was recent, but I actually think it was probably 15 years ago now, Rich. I can't even remember, but VA switched where they were using FHA approvals for their condos as well. Then they were finding that the FHA approvals weren't really coinciding with the VA standards of collateral. So they came up with their own list, and VA loans have to have their own approval. And that is the same exact thing. And that's, oh my gosh, we go to WebLGY, but is it va.gov? Is that what it is?
Yeah, it's va.gov. So both VA and FHA have ways to look up specific condo projects. And then, well, I'll let you keep going.
Well, there is one thing for FHA, that if you have a file that is not approved, you can get it approved. You can do a regular approval. It takes a lot of time. We have to go through regulations. Our condo department does that, helps everybody through that on what we need to get, we need to do, but it takes forever.
Yeah. I want to talk about that process, because I think we've been pretty successful in our spot. The official term for the agents on this call is a spot condo approval. So the association itself doesn't have an overall approval, but we can do a one-time or spot,
One
as they call it,
unit, right,
one
can be
unit.
approved. And that the process for that is very similar. Our underwriters actually go ahead and take that on because they make sure that it meets that one unit requirements. And we have been successful, I believe, in Michigan and Illinois, definitely in Wisconsin and Minnesota. Where we have not been is Florida, of course. Florida condos are, everybody needs to stay away from all of those because there are so many guidelines and overlays for Florida condos for all agency products. But so to do that, we did have one denial. I've had one denial probably in the last 6 months. And the reason why that single unit approval was not approved is because it did not have its own allowance for paint. So as silly as that sounds, they had to go through the HOA to get their paint and or / roof completed and done. So there are little specifics that the underwriters know for those guidelines. So it is a little bit difficult, but when you run into those, I would always reach out to Rich and his team because they have the ability to look those up.
Yeah, I want to talk just one last thing about the spots. So when we do spot condos, the key there is having a management company or an association that's willing to work with us. And that's typically the biggest delays are the amount of paperwork that we need from either of those two entities. It's definitely a little bit more than is traditionally asked for in just a normal loan process. We're asking for bylaws, declarations, budgets, and various things that wouldn't normally be requested. And sometimes the HOAs and or the management companies struggle with the providing of that documentation. So we've actually found if we have an association or a management company that's very proactive, that we can get these through the system pretty quickly and almost doesn't really slow us down in that sense. But we do want to get the approval before we order the appraisal, so that part is a little bit of a delay. We have had success. I would say when I check with our processors, they feel we're probably getting 1 out of every 3 we attempt through. And those are good numbers, certainly for somebody who's going to be able to go FHA. That's awesome. On the conventional side, not to spend a lot of time on the condo piece, but on the conventional side, Jolene, do you want to take, I think I'll let you take that one. I've got an idea relative to that, but I don't want to speak for underwriters, so I can't underwrite.
It's basically this. I mean, it's quite a bit the same as your government loans. We have to have the condo questionnaire. It still has to be approved. All those things. It has to have your minimum requirements. I don't think it's as difficult to get that approval, but it's still just important to have all the information up front. I think the biggest thing that I see that we run into with conventional condos is honestly the hazard insurance portion of it. Some of them don't cover as much as they should. They try to get away with the least amount as possible, of course. But that's where I've seen issues lately. And we have actually been able to get quite a few of them to up their coverage to make the homeownership possible. So I think that's a good thing. That's all I really have, though. We just have to make sure that all the documentation is complete. We have the minimum requirements, and then of course that goes on to our condo department, and then they take over from there and they do all the due diligence for that.
And what I would say to Vernita, what I would say is when you're entering into a transaction on a condo, you reach out to us. Because whether it's a government condo or a conventional condo, because of the volume of loans we do, specifically on the conventional side, there's a good chance we've already done a loan in that condo complex. We're doing close to $4 billion a month in lending around the United States. There's a good chance we have some exposure to some of these larger buildings, and they may already be in our system as approved. So we can come back to you and say, oh yeah, we just did one 3 months ago. Shouldn't be a challenge. The last comment that I'll make too is when we talk about insurance, insurance has become a problem all around the country. I travel a lot lately, and I was just in Los Angeles and in California. The insurers are pulling out, and it's a big deal. We just had a client here buying a 3 flat on the north side, got a $4,000 annual premium. They don't qualify with a $4,000 annual premium, so we had to reshop that out to get it down to 2,200. The insurance is a big deal too. So, all right, I'm going to get off of that. Ladina has been anxiously awaiting her question she put in the chat, which is, which type of loans, ladies, require reserves, or when are reserves required?
It depends. That's my answer for everything, just so that you
Yep.
know. That's
This is what I have to put up with, guys. So
Yeah, there's never a clean cut answer. It's always,
No,
well,
yeah.
it depends on the situation.
I know. Rich calls, asks the question, and I'm like, it depends. So truthfully, where you need reserves is on investment properties. That's the line in the sand. You always need reserves for investment properties. Where it is advantageous to your borrowers or your buyers is when we are, gosh, you have one single guy who's buying a house and he has minimal credit, and we're capping out where he's putting minimal down and he only has that 5% to put down. If he had additional reserves, we would be able to get that automated approval. It would go through quicker. So it's not that it's required, but it is a bump, right? It helps you to get that approval on those non-investment properties. But it is for loans that are cash out refis over 45% DTI, and then also for your investment properties, and if they own other investment properties as well that have mortgages against them. The goal for that is to validate capacity, right? Ability to repay. You have reserve left over after you do your down payment. That shows us that you're going to be able to make your payment if your employment disperses, and if you lose your job, if your income goes down, and so that just strengthens the file.
yeah, no, that's great. I mean, if your clients have rental property, they definitely have to have some money in the bank. Now, I do need to make one quick qualification because we've used the word cash. Unfortunately, cash itself, cash under a mattress and a mason jar buried in the backyard, that's a dirty word for our underwriting crew. So when we're talking about cash in the context right now, it's verifiable money in the bank. Cash is kind of a no-no as far as that's concerned. Now, Ladina, thank you for entering a question there. I really appreciate you. Suzanne Semino asks, and I like this question too. This is our second question as it relates to buyer's agent's compensation. By the way, I did see some of you guys talk about it as commission. Never talk about it as commission. It's buyer's agent's compensation. That's how you guys earn a living. You're compensated for your time to take great care of these folks. Now, the question for our underwriters, how is buyer's compensation viewed by underwriting?
I may be misinterpreting the whole question that you're giving to me, but to be honest with you, we don't look at that. When we're looking at the purchase contracts that come in, that's not part of our compliance review and any of our risk assessment. That does fall on Rich's team and you as the agent to make sure that you're within the standards that you guys have. We don't look at that. The only
I have one thing with that, Kim, though.
Yeah.
If we know if there's as part of the contract, it says my buyer's got to come up with 3% of the buyer's agent's compensation, that's money that's due at closing. So you are requiring that we have verifiable source of funds for that, though.
Yes,
so you're looking at some of it.
Add to their cash needed to close. So yes.
Okay. Yeah. So we will look at it from that standpoint, but I don't think it doesn't change their, whether they're going to approve or not approve the file, as long as the client has the funds to cover paying you, the agent, we're good.
Yeah.
So yeah. All right. We have a question in the chat from Kim. Has the VA changed their regulations about paying buyers agents compensation?
They are working on it. We are waiting because that is definitely a hot topic, right?
So what do
Um,
they did make a statement that they would, what are you looking for specifically? Because they did make a statement that after August 14th, they were gonna allow the payment from the seller's side.
yes, yeah. So that there is so the cap is not on there yet, right? That's what we're kind of waiting for to see if they're going to put some sort of a cap on there, but it is not. So yes, that has changed. I can send that to Rich, and maybe you can follow that up.
Yeah, so you're telling me that even though they're going to allow the veterans, buyers, realtors compensation to be paid, that they might actually be capping the amount of money that could come from
Think
the
that
seller?
they are, and that
Really?
that's what I've heard, but I haven't seen anything.
Mhm.
And I'll find the regulation and I'll send it to you.
So Kim followed it up, and I think this is the better question. What if the seller isn't paying it? So in other words, it is allowable, my understanding under the current change, the buyer can, the veteran buyer getting a VA loan can pay their realtor directly now.
I believe so. Yes,
Yeah.
that's how I've understood it as well.
Yeah, that's what so I did see that change come through. It came through towards the end of July with a implementation date, which was kind of weird based on when the actual lawsuit implied. It was kind of, it missed the date by a couple of days. I thought it was weird. Actually, maybe it wasn't even July. In June, they might have come out, end of June, beginning of July. But the bottom line is, Kim, right now the veteran can pay it. However, it looks like the VA may still tweak that a little bit. So stay tuned. Okay.
Yeah.
Gail, let's see what we got from Gail. Ba, 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 ba. Oh, oh, okay. We kind of talked about this a little bit. So we talked about, so she wanted to know if there's any red flags realtors need to know to help their sellers. Oh, there's sellers. That actually, we didn't really talk about that. So any red flags? So I'm going to go back to Gail's first question, but I like the second one because I think they're a
Mhm.
little bit different here.
Me too.
Any red flags realtors need to know to help their sellers have a smooth approval? Interesting.
Well,
Yeah.
um, I think that, let's see, red flags, and I'm trying to think about this from the seller's perspective of a red flag.
Yeah, I'm thinking, well, obviously value, but
Value, of
there's
course, but
really
the other,
nothing. Yeah,
yeah,
there's nothing a
and
seller
credit.
can do about that. I'll tell you one thing that I think, and this might not be an underwriting thing, but it's really important because it does catch agents and sellers off guard. When we talk about, if any of your sellers went through the pandemic and created a forbearance scenario, and what forbearance is they chose to not pay their mortgage payment because of the pandemic, because it was allowed during that time, and they accumulated some interest payments that were not paid. And the way the law is set up, they were allowed to take that portion of unpaid payments. One of their options were to take it and add it on the back end of the loan. And what we've seen is that balance doesn't show up on a mortgage statement. So the client still thinks they have X balance, but all of this accrued interest and payments is kind of hanging around in the background. Well, guess when we find out? When the seller's attorney orders a payoff. And we've actually seen a situation where a seller was unable to sell because once they ordered it and they realized there was a forbearance amount of like 22 or $24,000, the seller was 8 grand short to sell. Like they would have had to come out of pocket $8,000. So from a listing agent standpoint, one of the questions you may ask when you're working with your client, if they have a mortgage, did they take advantage of the pandemic government rules that allowed them not to make payments during the pandemic? Maybe they weren't working based on whatever their industry was. And did that create any other additional debt? A lot of people just forget about it. It's not even on the mortgage statement. But that's something that could save everybody a lot of time and headache. as far as that's concerned. All right. We got that. Oh, okay. So what is the process an underwriter takes when they receive a file for review, and what do they look for? We kind of covered that in some of the C's. The process before that, though, I'm going to cover that because that happens at our level with our processors. Our processors are going to review everything submitted by the originators. They are going to turn around and ask questions back to the clients on things that were submitted that don't make sense. Processor's goal really to get to the underwriter is to make sure the file reads cleanly. What we've found and way I instruct my processors and my loan officers is make sure the underwriters don't have questions, because what happens is the minute they start asking questions, that lots of questions seem to follow. But if everything makes sense to them and they could read through it cleanly and get through it cleanly, we're not going to get a lot of extra conditions. We're not going to get a lot, and it's going to make for a nice, smooth process. So on our end, our job from processing and origination, tell a really good story that makes sense, puts it all together, and doesn't leave question marks. Because question marks are where deals start to either slow down or die. So we don't like those. So I don't know if you ladies want to comment about that, but I think I kind of addressed at the front end of that question.
Yeah, I think the three C's definitely
Mhm.
go hand in hand with this. What we do have is, of course, guidelines based off of what program you're doing. So I think that that's the risk assessment that goes along with the whole big thing. But again, under the umbrella of all of that stuff is ability to repay and collateral. That's the main
Mhm.
thing.
Speaking of collateral, Gail's next question is, how far from the subject property can they search if nothing has sold in the last 6 months that would be considered a comp? Now, we did do an ask the appraiser, but you guys eventually are the ones that are going to look at the appraiser's work. So I'll let you comment on what you guys think is acceptable based on how far an appraiser can go to find comps.
I I love appraisal questions. So Jolene, if you
Ah,
want to jump in, please let me know. But I love appraisals. I love appraisers. I know that they get a bad rap, but uh, they always say, right, that loan officers and agents are looking at future, right? Um, Underwriters are looking at current, and appraisers are looking at the past. So I think that that's why we all are a little bit always just like, you know,
Mhm.
pushing the envelope to each other. So appraisers, we in underwriting, I'll tell you, there are minimal guidelines that go with how far you have to go for comps. There are minimal guidelines on time frames of comps. Now, that does come back to us as the reviewers and the accepted, whatever, of the appraisal, the report, and the value. So if you're looking at a rural community and it's over 6 months old, or it's over 2 miles away, then the appraiser has to address that in their report. So that's what we look to justify accepting the report or not accepting the report, which is why I love having conversations with appraisers, because they're there. And in underwriting, I can't say you didn't use a good comp because there's a comp right here, because there could be a reason why they didn't use that comp. So in any appraisal that we get, we instruct our underwriters to read that narrative with a fine-tooth comb. Make sure that you're understanding the whole picture of what's going on with that property.
so
There's no, oh, sorry. Go
no,
ahead.
it's okay, Kim. I want to go back. I want to go back to Gail's question though, because I think
Mhm.
she still wants to know, like, hey, how far can I go? And I'm going to answer this, but I want you guys to kind of follow up and provide a little clarity. So, what I think she's talking about is, hey, look, I went a half mile out, no sales. I went a mile out, no sales. And so how far can she push that envelope? Now, on a rural property, and I'm only sharing this from our conversation when we had Ask the Appraiser, which we did earlier this year. On a rural property, and an underwriter is going to give you a little latitude because these properties aren't next to each other. You know, they're not next to each other. If you're talking about cities in our community like Marengo, Harvard, and those places, these properties, you know, you don't have neighbors next to you. So the next likely property could legitimately be 2.5 miles away. Now, let's talk about a more urban setting. In a more urban setting, suburbs, Elk Grove, Schaumburg is an example, South Holland, whatever. The fact of the matter is you need to try to stay within that community, specifically within that school district. So jumping across the street into a different school district, as you know, and certainly our agents know in the Chicagoland area, it's a huge price comparison depending on which high school district your house lands into. It makes a difference, unfortunately. And so, you know, the latitude to jump is really restricted ultimately based on that. You know, so that being said, I think, you know, I'll let you guys kind of talk about the urban, how far and a realtor can go. I'm thinking for Gail, she's probably like, hey, how far can I go to provide comps to the agent when the agent comes to the house, I'm sorry, how far can I go to provide comps to the appraiser? Or if I got a short appraisal, how far can I go to justify my number?
Right. Urban markets where we are currently moving, right? We don't have declining values. We don't have stagnant sales. Mostly it is a seller's market still. We look for a mile or less.
Okay.
And again, if you've seen the appraisal reports, the appraiser does state where the neighborhood lines lay. And for all programs, whether you're doing a Govy loan or whether you're doing a conventional loan, it is all about marketability. So you're validating that if, as a lender, we had to take on this loan under a foreclosure adverse action, that we could sell it pretty quickly, that we could get what we loaned out on it, right? We're covering our own risk. So urban, yes, 1 mile. Urban, have I done urban where it's 2 miles? Yes, but I have to have a reason why, and I have to show that there have been no sales. Like,
yeah, that works. I'm going to stay. Ty's got a question in the chat that I want to get to, but I'm going to
yeah,
jump to Richard Grieger's question because it's kind of on the appraisal vein. So I want to jump on that. Then we'll get to Ty's question in the chat. Richard Grieger said, what is the ruling on basements that have a stone or gravel floor?
so this is always a tough one.
Jolene wants to answer that
These
question.
are
I can tell.
crazy questions.
I know,
I mean, we
crazy
run
questions.
into weird stuff, but it's like, I don't think I've ever seen a stone or gravel floor.
Right.
Well,
What are you guys selling over there?
Richards and Elgin, we've got some fairly old stock of properties in Elgin. So that being said, so we've got a gravel or stone floor. What is FHA? What is Fannie Mae going to do with that?
Yes. So again, marketability. Are your comps similar? Are they using a crawl space as a basement as opposed to actually being gross living area? So there's a lot of other questions that go along with that. Is it part of the foundation? Is there issues with it? Could there be issues with it? It's not a definite no, but it is something that is a huge concern that we have to evaluate that property individually. And I have yet to do or allow one.
Or allow one. No kidding.
Yeah.
Okay.
Yeah. We had one, I'll tell you truthfully, we had one and they called it a basement, and it wasn't in Illinois. I believe that it was it Missouri? It might have been in Missouri. I can't quite remember.
I think it was Missouri or Kentucky. I can't remember.
And it did have a dirt floor, right? And it was a crawl space, but they were trying to use it as a basement because all the other comps, which higher values had basements, not similar basements. because it was a true crawl space. And per the county and city requirements, it didn't meet the height requirement. It was like 5 foot. And I believe that they had it at 6.5 was where it was supposed to be, or 7. I can't even remember now. And so we could not do that one.
Yeah, and you made a comment about denying that one. Are we denying the value on that, or just denying it flat? In other words, you guys.
No, not denying it flat. We're asking for them to adjust the value to not
Correct.
include it as a basement, right?
Yeah,
To
that's
approve it
yeah.
as a crawl space.
Yeah, so I just wanted to be clear. We just couldn't stretch those other comps into this property because truly we're dealing with a crawl space versus a basement. Not that we wouldn't do it, it just didn't comp out, unfortunately. All right. Ty, who is one of our lucky winners last night at our wine event, great job. And also helped me out for a little charity. So Karma paid her back. She had this heavy basket. So anyway, she said she's got a question in here, and I think I want to address it. And then if you guys want to kind of follow up with that. So got a buyer who is 1099. Ultimately, that means they have some self-employment out there, and also has a part-time W-2 job. Can they qualify for an FHA mortgage? In the short answer is yes, but then we're going to default to Kim and say, what's your favorite word, Kim?
It depends.
There you go. So it really is going to depend if that buyer at the 1099 has a 2-year history, which FHA is very rigid about. There's really no wiggle room with FHA, and they have a 2-year history of part-time employment.
Yeah.
They're very rigid about that. They're not rigid about a lot of stuff, but your time on those types of jobs is for sure too. Now, conventionally, we can get a little latitude sometimes on those, but if the part-time job's brand new and it just started, it's not going to be acceptable income for us. Same thing with the W-2. So those answers to Ty and any other agent listening here, longevity in both of those are going to be, we're going to be looking for 18 months to 2 years, 2 years for sure if it's FHA. Documents needed. Anytime you have a 1099 employee, tax returns are mandatory. So tax returns for sure are mandatory. If we're later in the year, like we are now in September, we're going to be looking for year-to-date profit and loss so that we have an idea what that income looks like in 2024 and 2 years tax returns. Occasionally, we'll get an exemption to do 1 year's tax returns, which would be just the 2023s. But most cases, the client should be prepared to provide 2, and then we can kind of sort that out as we go through the underwriting process. Did I miss anything, ladies?
Nope.
Nice. All right, good deal. I still can't underwrite. All right, just make that clear. All right.
I will say that usually like if for some reason the agency does allow 12 months, it's because you have some really good risk factors. Like they have good reserves and they have all the things. And sometimes it'll be like, this looks like a really good loan when it's run through. So they'll be like, okay, well, let's just show 12 months of self-employed history on the tax return. So it just depends on what's in the file and what it's reading. So.
And so when Jolene says agency, she's talking Fannie or Freddie.
Yeah, sorry, Fannie or Freddie.
No, that's okay. That's okay.
Yep.
All right. So Regina, hi Regina. Hopefully you're here. I love you. She said, what factors could cause delays in the process? What factors? I think we've talked a little bit about that. The fact that we as an originator and the processor didn't tell a great story. We've also talked about the fact that the client's just sitting on their documents. They're just not getting documentation to us in a timely manner. With that, ladies, can you think of anything else?
Well, the big thing now that we're kind of seeing, which is a trend nationally, is appraisals. Which is the value doesn't come in, and so now we're back and forth with an appraiser to try to get that sales price. So that tends to add some time to it as well. I think that it is just a lot of the hiccups that we've been talking about through the whole meeting. But the main thing with us is we in underwriting want to get it in and out as fast as we can. when there's a hiccup, we let the sales teams know right away so that we can try to find a resolve. Appraisers and appraisals are on their own timeline, unfortunately.
Yeah, no, we get that. All right, speaking of appraisals, so we got a theme: buyers, agents, compensation, and appraisals, right? Here's another appraisal question for Margaret, and I think she has an opinion on this. You guys will find out why in a second.
All
When
right.
comps are given to justify a sales price, why are they always rejected? Why, Kim? The agent gave you comps. Why are you rejecting them always?
I don't reject them. Well, I'll tell you that the number one reason is that the comps have to close before the report date of the appraisal. That's the number one thing. So if you have a comp that closed after the appraiser did their report, we can't do anything. There's nothing that we can do with it. What has happened before in the past, we do get comps. I personally, I think Jolene and I both get those reconsiderations of value to look at first before we start knocking on the appraiser's door or asking the team to get the appraiser involved, or our appraisal review team as well. We pull everything that we can to validate that the comps that you provided are valid and meet the turn times and are comp like our subject, right? Are good alternatives to our subject. Sometimes it just happens where it is not, where the quality is different, and we research the quality of the appraisers comps, that sort of stuff. I will say though, in the last 2 months, because appraisals have been a little sticky lately, I think we've gotten at least 3 to 4 overturned.
I feel like we've had some pretty good wins as far as providing additional comps lately. They've been pretty open to it.
Has either helped us, or we were able to find a material deficiency on the appraisal and order another one.
Yeah, and we build our panel out here specifically. So from an appraisal world, our appraisers on our panel, I think, do a really, really good job. I don't find that here, at least on the orders that I do, we get a lot of pushback. The most important thing to you as an agent is that my appraisers don't submit stuff all the time that underwriting goes, nope, 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 stop, this isn't right, this isn't right. So our stuff goes through pretty well. That being said, yeah, of course, they're going to come up short every once in a while. Now, the issue that I have with comps is that, just had this conversation this week. Somebody was talking to me about comps. We had a raised ranch, big raised ranch, and I want to say it was Streamwood, and they were giving me comps, and we started to talk about it. And as we talked about it, she said, well, this one has no basement, but it's a 2-story. I said, okay, but the problem is in Streamwood, there's plenty of raised ranches to use as comparables. Raised ranches are not 2 stories. And so they have to be a like property with the assumption like properties are available. Those of you who know that Streamwood market know there's plenty of raised ranches that sell all the time. Carpentersville, plenty of raised ranches. So those are communities that are going to have lots and lots of comps. You can't bring a 2-story into a party when we got a lot of raised ranches. So the comp itself, Margaret, needs to be consistent with not only the property style, but the square footage. And that's when we talk to appraisers on the class, as an example, gross living area, they use GLA like all the time, but gross living area is a huge factor in making a determination. If we've got an 1,800 square foot property and you're throwing 2,800 square foot comps, it's not even in consideration. They can't even adjust that into the appraisal to where our underwriters are going to go, oh yeah, that's okay. You bought a $3,000 comp, 3,000 square foot comp, that'll work. So it's very, very difficult to do that. All right, we've got Paul has asked a question. I read this once and I want to make sure I can understand this. So this was in our Q&A, so thank you, Paul. Big old houses in Elgin. Yes, we have a community that has these big old like Victorians with the wraparound porches. Like a lot of them could be models for doll houses. That being said, are harder to collect comps within 6 months. I can find a decent amount of good comps within a year. And I don't think it's generally understood that if a property sold for 1 year ago, that has increased in value at least 3%. So it seems like these comps would be good to use. So when I do a CMA for such a house, I'm using 1 year and not 6 months. So I think if I break that down for the underwriters, and I have kind of an opinion on this based on the conversation I just had on it, but if I break this down, he's saying inside of 6 months, we don't have comps. So we got to go out to 12 months on some of these bigger Victorians out there. He's making the assumption that we can get at least 3% appreciation, which I think for Elgin's very fair. It's probably conservative. That being said, I don't know that we've got a question as much as he's just trying to justify, can I use those comps from a year ago?
Time adjustments are a big thing that we all talk about, right? Time adjustments have to be substantiated by the appraisers. And if it is similar to the 3%, then we should be able to have a current listing / sale that shows that that is consistent with the market and the type of home that they're selling. Does that help?
No, I think it helps. This is when I mentioned I actually had a conversation with an appraiser about this. We had an agent that was putting in an offer and they were kind of curious about something. So we just called one of our appraisers and they had said to us, the comps that the agents were providing were so fresh, you couldn't put a time adjustment on them. So what a time adjustment essentially does is if you had a comp from 6 months ago and that community is appraising at 6% annually, you could reasonably build into the appraisal that the comparable from 6 months ago had a 3% appreciation because he can justify that. The issue we had in that particular conversation was the comps being provided were fresh. Like we couldn't get the extra, we couldn't build appreciation in because they all closed within the last 30 days. So to Paul's question, I think if you are using something from a year ago and you're doing a CMA and you're very confident about the appreciation in that community, you can certainly build that into the CMA. And providing that there are no comps in the last 6 months, that appraiser is going to do the exact same thing you did. So ultimately, good job. All right, let me get the Q&A out of here. Paul said thank you for that. And we've got, let's see here. We got 4 minutes left. We're going to ask one more question. If anybody else has got anything else for the chat, plug that in there. Let's see here. Not sure. Okay, so Kim's question is, can you explain any conditions or contingencies that might be placed on my loan? Boy, that's a pretty loaded question. What can I do to improve my chances for approval? Really the biggest thing, it comes down to the originator and the processor. If they do a great job, and unfortunately sometimes for your clients it can be annoying because we ask for a lot of things. My team would rather ask for more and need less than ask for less and need more, because all that's going to do is aggravate your client when I got to come back to them. The worst lenders anywhere in the United States are the ones that constantly nitpick your clients for stuff. That is a sign you're dealing with a really bad lender that doesn't know what the hell they're doing. They're fixing one problem and now catching another one, fixing one problem, now catching another one. Rather than making the whole, fixing everything at the same time, that just shows some massive disorganization. As a lender and an originator, I want to ask all the right questions, get all the right documents, put a great case together, and give underwriting everything that they need. Now, that being said, there are a couple things that kind of come up that sometimes we wouldn't catch in an application process. I'm going to talk about 2 things that I can think of, and then I'm going to turn this over to the experts. One of those things would be if our client had any type of claim against any government agency.
Mhm.
In other words, maybe they defaulted on some student loans and the student loan lender went and made a claim to the government and said, hey, I got stiffed for 20 grand. So we're going to do some research there and we're going to say, oops, there was a claim. You're trying to come to me for a VA FHA loan. And I see that we've already paid a claim out on some other type of lending you had, maybe even a mortgage, and you can't get new lending government wise. Now we do that due diligence as quickly as we can, but it's typically not done when I'm just talking to somebody and running their automated underwriting. The second thing that comes up is we do a property search on people, but again, that's done later in the processing process. And in the property search, let's say one of your clients inherited 1,000 acres in Iowa from when her grandmother died 12 years ago. By the way, they've never seen the property. They have family that manages the land. It doesn't show up on their tax returns. But guess what? I just did a property search all around the country and their name's on that property. So now I have questions like, what are the taxes? What's on that? You know, we have to start doing some due diligence on something even the client may not know about. So those things are kind of gotchas. If you get fully underwritten by us, we take all of those gotchas out of the table because that's our job, is to do the fast track. That's what we call it, and turn the pre-approval into a fully underwritten approval. Ladies, is there anything else you can think of on that? And we'll close with that because we officially hit 1 o'clock.
Okay, well, I'll just say really quick, again, the agency's hot topics and hot trends are income, right? Like I had talked about the income, and not that that's a gotcha, but it is something that raises that that your buyers are not aware of, that your buyers
Mhm.
think that they're doing all the right things and they're not. The other main thing that is on our radar all the time is assets. When we're validating where their cash to close is coming from, their funds to close, we have to validate any withdrawals that are on their account. So if they have any debts that are not showing up on credit, or if they've taken uh, they've done those Affirm loans or Klarna loans, we have to hit them for those loans. And
Mhm.
people do those quickly, right? Like they're buying stuff on Amazon and they think, oh, I'll just make my $20 payment. So that's the big thing that has been on underwriting for the last 6 months. Like it's been a major change for us to have to go back on those things. And I think working with processing, and especially Rich's team is great in
Mhm.
catching those things up front and like letting us know so that we're not playing a back and forth between us behind the scenes. But that is something that the borrowers just don't even think about. You know,
Yeah.
and it's hard. Uh, we know you have a hard job. We know that Rich and his team have a hard job being front facing with with your buyers, because um, this is the biggest purchase they're ever going to make. And in underwriting, we know how important it is. So we try to make it as easy as possible. And with Rich's team, it is, because
Mhm.
we work well together for sure.
I want to cover one thing. You mentioned hot topic, and this is almost a bonus for you guys, but I think it's really important. And we talked about this, and if you guys have something else to add, I would love it. So, hot topic. You have a client who has their own home. They're looking to buy a new home, and their lender or even the realtor has said, hey, the only way you're probably qualifying for the new home is if you rent the old one. Okay, that's reasonable. There's guidelines that allow us to offset that old
Mhm.
mortgage payment. However, the guidelines have become stricter and stricter around that piece. Like A, we need a lease. B, we need proof of a canceled security
Mhm.
deposit check. So we need to know that there's some intent. I've had situations where agents had said, "Oh yeah, we'll get you a lease, no problem," and almost kind of being dismissive in the fact that we legitimately need this buyer to rent this house. So here's a hot topic. Fannie Mae and Freddie Mac are checking those house addresses 60 days from now. If that house is on the market, CrossCountry gets to buy that mortgage back. That's a problem. That means that somebody actually was not truthful. And as much as we hate these two words, it's mortgage fraud and we don't get involved in it. And you guys should know that if you actually assisted in that, the people with the licenses are the ones that are going to be made example of. When some governmental body knocks on the door of your consumer and he says, I didn't know I did anything wrong, my agent told me to do it. You and I are both going to be held at a much higher standard and potentially risk your license. So that's a big deal. I want you guys to be very aware of that. We are cognizant of that. We don't do any of that stuff. So that's not a loan for CrossCountry. Is there anything else that agency or FHA is looking at that would be kind of a new thing that we need to be aware of?
There's not anything new. I do have something to add. What we've seen a lot of lately is, and this can help when when they're out shopping, things like that. We've seen a lot of people put earnest money down that can't be verified, but they have to use it in their transaction. So it's very important that they're aware that, you know, we really can't take cash. Like if they have $5,000 into their mattress, it's really not something that we can verify. So we need to make sure that they have some type of gift or something that we can use so they have enough funds to close. I know in the past 6 months, we've run into several loans where we're getting right down to the very end and we're having an issue trying to find enough funds for them to close because there's money that we can't verify. That is so super important. And it's stuff that starts out up front before the loans even came to us or the loans even went to the loan officer. So if you can get them to get their money from an eligible source up front, it alleviates such a big headache later.
That's a huge thing because a couple of the agents asked through the process, Jolene, that, you know, what can I do to better prepare my client? And ultimately, when they're giving you guys earnest money, I would strongly recommend you say, hey, where did this come from? And so that you don't have these problems. Denise, one of my processors, it's very common for our processors to pull that out of the transaction because they can't even verify where it came from. So we'll verify that they have other funds to replace that, but we don't ever verify the earnest money. We have to actually pull it out because it's, again, became cash. All right.
Yeah, and it's so important. Yeah, thank you.
That being said, we are past our hour. Thank you so much, ladies, for giving us your time. We really appreciate your expertise. If anything came up for you agents that you want an additional follow-up on, please email me. We have 3 different events coming up. Number 1, we do have a home buying class that we do twice a month virtually via Zoom. The next one is tonight at 5:30, between 5:30 and 6:30. We do a home buying class. You agents should definitely send your buyers here. They will be better prepared. We talk about some of the stuff we've covered today so they don't have problems on their mortgage. Number 2, we also have our Save the Planet Week on September 26th at 9 a.m. A whole bunch of CrossCountry employees and realtor partners will be at Feed My Starving Children in Aurora. If you guys are interested in coming out and doing some good with your time, we do this twice a year. It's a lot of fun. We just had our event on the north side at DuPage Pads. We're going to be at Aurora in September 26th. Last but not least, if you have kids or grandkids, we're doing a trunk or treat at our office October 19th. I don't have the hours, but we have that trunk or treat coming up. Check that out. We'll get you guys more information. We're going to have lots of trunks out here and lots of fun. Thank you guys for participating. And 2 to 4. Tony just told me when my trunk or treat is 2 to 4. All right, Jolene and Kim, thank you guys for everything. Thanks for, and Tony, none of this happens without you. Thank you very much.
Thank you.
Appreciate you all. Bye, guys.